We know the stock market's been on the move, but the bond market has been on the move as well. Down, stock or bond prices lower, but yields moving up. In fact, the benchmark 10-year yield moving very high, well, relatively over the last year or so. There you see the move back to 2.44%. But maybe it is the rapidity of the move that we care about. Boris Schlossberg and Matt Maley, your Trading Nation team today. And, you know, no one's trying to say, Matt, that 2.44% is high. Okay, that's very low. I remember when the 10-year hit 4%, we thought it had collapsed. So 2.4, still very low. But what do you make of the fact that the 10-year yield is up 30% in 30 days?
Yeah, we have to look at what's really going on. We've had three issues, as I see it, that's caused the rise in yields. Number one, of course, is the election of Donald Trump and that the expectation that he's going to help the economy grow quite a bit. Number two is that we're now getting data that shows that the economy has been getting better even before he was elected. But number three, there's also been some forced selling. In other words, the forced selling taking prices down and taking yields up. And that's come from really from the mortgage-backed security area. It goes into what's called convexity hedging, which I want to go into too many details on it. Other than that, mortgage-backed securities, they have to hedge their, or they like to hedge their interest rate exposure. The problem is interest rates move higher, that people don't pay back their mortgages as quickly. So that is, people aren't going to go out and refinance at higher levels. So that changes their duration, and it means that they have to change their whole ratio, their hedging ratio, and adjust their hedging ratio. That causes them to sell treasuries. We saw the same thing during the taper tantrum of 2013. That took things down too much, took rates up too high, and once that forced selling ends, like it does whenever forced selling ends, you get a big air pocket, and so you see a big bounce. So people need to be a little careful, because I think that the bond market could see a decent bounce very soon, which will also impact these interest rate sensitive groups that we've seen big moves in as well.
I thought that was a very good explanation of a complicated topic, Matt, seriously, because that might explain part of the rapidity of the move. Boris, I guess the question is what's going to happen then? Do you think that we sort of just saw all that move in the trading that Matt just talked about, but now it's kind of over, and do you expect yields to kind of stay where they are?
Yeah, Brian, always in finance, it's never the absolute value. It's always the relative value that matters. And it's like you said, it's the fact that we had this just massive move of 30% in 30 days that I think is kind of shocking the market. We are at very, very key levels here at almost 2.5% on the 10-year, above 3% on the 30-year. And I think those levels are going to be very much the key pivot points, because at this point, I think the bond market is essentially in a feed the beast type of territory. In other words, you need to have 3% growth. You need to have growth accelerate over the next couple of quarters in order for these yields to stay up. And that's going to be the key telling question. If that indeed continues, if the U.S. economy continues to improve on a relative basis, then the yields are actually going to go higher. But if we sort of stall at this point, we're going to go right back to where we were, closer to 2%.
Okay, so we're watching this big move here, and a pretty interesting explanation from Matt about mortgages. And I think, guys, the next segment probably needs to be whether or not it's going to impact housing. Well, we'll see. Matt and Boris, thank you both very much. Folks, check out the live version of Trading Nation, usually in the 2 p.m. Eastern Time hour of Power Lunch on CNBC every day. I'll see you there for that. We'll see you here next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.